Director loan account. If you're running a limited company, sometimes you'll hear your accountant say to you, you're running a director's loan account. Now there's two ways to look at this. An inbound director's loan, which is you funding money into the company, and often you'll do that on a pre-startup. You may put £1, £100 or £1,000 in. That's a positive loan to the company that you can repay to yourself once it's got profit available through the business. If you're trading and you're drawing funds from the company and you're doing the opposite of that, you'll have a live director's loan account where you're drawing money from the company that is beyond the means of the business typically. So when you're running a company, things to think about that you'll draw. You'll always consider taking a salary from the company. Either you'll just be using your personal tax allowance or you go beyond that. Again, everyone's different. That's subject for another session. Dividends. You'll be drawing dividends from a company because it's a good way to distribute further revenue to yourself as profits. And equally, you'll be covering your own expenses. Sometimes what happens, and again, let's use an example here that you've got 10,000 salary, 10,000 dividend, and 10,000 expenses. If, on the other hand, for you as an individual, you'd actually spent £40,000 over here, and you were trying to claim that £40,000 or draw that £40,000 from the business. Certainly, we've got £10,000 in salary, we've got £10,000 in dividends, and let's say they're all qualifying allowable expenses, we've got £10,000 in expenses. But every now and then, you may have needed more. You've drawn this and you needed to buy a car or put a house deposit down. If we don't know this as accountants, we won't know what to call it because we won't know if it's salary, dividends, or expenses. So what will happen? Your accountant will have a £10,000 pot here, which will be called a director's loan account. Now, in the event as we get to the end of your tax year, your business tax year, you decide that you have actually had, or we find that you've got further expenses, you had allowable profits of the drawable dividends, or you wanted to increase your salary and the business had funds available, then it can be partially re-tagged back into these different pots. If, however, the business is overdrawn, but not at the bank account, but in terms of the profitability of the company, then this director's loan would sit here. The tax implications are interesting, so this is where you need to consider what you're going to do with the money. If it's sat there in the business as a live director's loan, then HMRC will charge you something called notional tax. And this is something really geeky called Section 455 tax, if you want to go and look at the boring tax records. And that's a tax levied on your company to suggest that it's loaned the money to you as an individual. Until that's paid back, your company will have paid 25% in tax on the basis that it's loaned you the money. When it's repaid, your tax liability goes back down. If you've drawn this as an individual, then obviously in the next tax year, we'll work out where it goes back in here and it suppresses the loan down. Now, a lot of people get confused. They just think, well, it sits there, I've paid the tax on it, just leave it. You do need to clear it down, and the objective of HMRC is that that money is repaid within 9 months of your year end. So what's a year end? So if you work on the basis that your tax year starts on the 1st of January, let's choose a year, your business would then finish on the 31st of December. So that's your corporate tax year. This is when your annual return is filed for your company, and this is when your annual accounts start to become due. You then have 9 months to file your annual accounts and your annual statutory filing. So you've really got up until September the year after in order to file everything. Now, again, with the director's loan, as long as it's repaid within this period here, there's no tax liability because that tax will be wiped out because it's been moved back to another pot. If it's still live at this point here, then that's when the tax liability starts to fall due. And it has to be accounted for and accrued within the company accounts. That's a director's loan account.